All right, concluding on the presentation on Chapter 11. My hay fever or whatever it is doesn't drive me and the rest of you crazy with the coughing and all that. Try to get through the rest of it with a minimum of that. We're on slide 62 on retained earnings restrictions. Retained earnings can be restricted in several ways, and this can affect the amount available for dividend declarations. So it can be legal restrictions, contractual restrictions, or even voluntary restrictions, and these should be disclosed in notes to the financial statements. Now on to slide 63 regarding the presentation of stockholders' equity in the balance sheet. So we've already seen some examples here. The two most common items, of course, are the capital stock, which takes in both common and preferred types, and additional paid-in capital. Excuse me, on slide 64, here's a more comprehensive example of the stockholders' equity portion of the balance sheet, in which most of the items covered in this chapter are presented. Note the descriptions of both the preferred and common stock so that the reader can see the characteristics of each. Note also how the additional paid-in capital accounts are separated by preferred and common stock amounts, and the note on the restriction of some of the retained earnings. On slide 65, here's a measure of performance regarding the dividends paid over the year. The dividend payout ratio is the common stock dividends declared divided by net income. In Nike's case, this ratio increased considerably between 2008 and 2009, indicating a higher payout but also a lower net income. On slide 66, the return on equity ratio measures how well the company performed from an income standpoint as measured against its stockholders' equity. See the calculation above, which subtracts preferred dividends from net income and then divides the result into the average balance, beginning balance plus ending balance divided by 2, of common stockholders' equity. In Nike's case, the ratio decreased from 2008 to 2009 since net income decreased. Since this measure is concerned with common stockholders' equity only, that is why preferred dividends are subtracted from net income in computing the ratio. On slide 67, this slide shows the positive effects of using corporate bonds payable versus stock. There are 3 distinct advantages as shown where shareholders are concerned. The stockholder control is not affected, tax savings result, and the return to the common shareholders may be higher. On slide 68, the text on page 595 discusses what goes into a decision to use debt financing versus stock issuance when raising new capital. The rule of thumb is as long as the company's return on assets exceeds the rate paid on debt, a company will increase the return on common stockholders' equity by the use of debt. See the example on page 595 showing the 2 alternatives, which is also shown on the next slide. So moving to slide 69, you can see here that although the net income under Plan B is lower, the return on common stockholders' equity is greater, almost twice as high under the bond financing scenario. And on slide 70, notice on the entry to record the declaration of the stock dividend, retained earnings is debited, that is, reduced. There is also a paid-in capital credit to recognize the amount over par that the stock dividend was issued for. That is the market value of $15 per share versus the $10 par value. The effect of this transaction is to shift $75,000 out of retained earnings and into paid-in capital, as stated previously, so that there is no overall impact on the total stockholders' equity. On slide 71, when the stock dividend is actually issued, akin to the payment date for cash dividends, the entry is as shown on this slide. The debit is to the distributable account, which is akin to a payable account, and the common stock account is credited accordingly for the amount of the stock dividend. And our obligatory look at IFRS, again, not to be covered on quiz or exam. In this area of stockholders' equity, there are some differences between U.S. GAAP and IFRS. This is due in part to the way corporations structure their finances in other countries versus here in the U.S. And on slide 73, this slide provides a good comparison of some key stockholders' equity terms and how they differ between U.S. GAAP and IFRS. Again, this material is not testable, just for information purposes only. And with that, we will conclude the presentation on Chapter 11.